So fundamental analysts, I think, and Greg, you began your career as a fundamental analyst, often think of the way to approach high yield as going to find a high yielding security and then underwrite it to make sure that it'll actually return that yield. But what you're arguing is that the base rates of return are actually better at lower yields because those bonds tend to get upgraded then to earn their yields. Whereas the lower yielding stuff, no matter how good you do your due diligence, something surprising inevitably happens that was in some ways priced into that risky security, and you don't earn your yield. And I think that's a very fitting segue into what we've seen so far this year, which is a big surprise. I think nobody anticipated exactly what was going to happen, that we'd have a global pandemic, that we'd be working from home. Everyone will be working from home, and what would have happened to credit market would have happened. I think everyone was fairly bullish in January. In fact, there were a lot of analysts putting out reports that were saying that the biggest opportunity in corporate credit was in the triple C space because that had lagged the market in 19. So Greg, tell us what's happened over the past 3 months in credit markets and where we are today.
Yeah, and it's not even 3 months, it's really 2 months. It's been quite rapid. This has been one of the most rapid sell-offs, I think, in credit markets as well as equity markets, as everybody knows. We've really gone from what were on the high yield market a 5.5% yield to a 9% yield on high yield in the course of just over a month. And the high yield spread now is at a level last seen in 2009. And in fact, when you look at historical episodes when we've passed through the spread level where we are right now, or the yield level is the easier way to think about it on the high yield market, the dates are going to be familiar. It was September 2001 and it was September 2008. So it was 9/11 and Lehman. And when you go and you look at those periods of time, you are at the beginning of, you actually realize a whole lot of the sell-off in the equity market, and you'd actually realize most of the sell-off in the high yield market by that point. So we're really at recession levels right now in high yield, and there's a whole lot priced in that was not priced in before.
So where do you think, I mean, you were rather bearish, saying that the best people could earn was 4% a few months ago. I think very vocal about criticizing the private credit markets. Where are you now on the bearish to bullish spectrum on high yield, Greg?
I mean, I have to say that I've gone from being bearish to I feel like you have to flip to bullish now. The numbers are what they are. We are at high spread levels. You are locking in returns on companies that you've heard of. These are large names in high quality, high yield that are yielding 5, 6, 7%. I mean, some of the names are like Levi Strauss, NRG Energy, Netflix, Charter Communications, Match Group. These aren't small names that are giving you 5, 6, 7% yields, where yes, their numbers are going to be terrible. Yes, we know that the environment has dramatically changed. No, we have no idea what's going to happen. But I think if you are a pension fund who was out taking a lot of risk trying to find the 7 or 8% or 6, 7 or 8% return you needed, this is a gift. You don't get this opportunity very much. One of the things that we've spent some time doing is going back and looking at those past crisis periods and saying, okay, when you've had a spread widening and an equity sell-off like we've had now, not just in the history in the period of time where we have really good history, but going back also a little earlier to 87 and the recession in 1990, and saying, if you had to make a choice about what to buy and you dove right in, what would be the best thing to buy? And the answer isn't equities, because it usually takes equities, and you can speak to this, and I'd love to have you talk about what you're seeing in equity, but it usually takes 2 to 3 months for the pain to play through in the equity markets. You usually have more downside from the initial spread widening or equity sell-off. The same is not true for high yield. With the exception of 2008, which was a financial crisis, you, within a month to 6 months, were already into positive returns, and almost always into positive returns after 12 months. And those returns were substantial, substantially more than just what the yield said you would earn, because you had spread compression, not even all the way back to where it used to be, but you just had improvement in the underlying spread environment. So we look at the environment now, and high yield has sold off just as rapidly as equities, except these are contractual assets. They have a maturity date, they have a coupon. A lot of the uncertainties inherent in equity What are earnings going to be? What are are they going to add more debt to layer you? What's going to happen in equity aren't really as difficult to figure out in debt, because especially if you're sitting below a large equity market cap, it's really just a question of whether they're pay off or not. And that's a much more tractable problem.
And what have you seen in terms of the last few recessions, Greg, about the base rates? About, let's say you bought triple Bs, double Bs, single Bs, and triple Cs, right before the recession and held them through. What percent of these things are going bankrupt and what percent are paying off? Where do you earn your yield and where do you get crushed in credit?
In a crisis like now, your obviously default rates go up over the next 5 years. So single Bs are going to default at something like a 30% cumulative default rate. Triple Cs might even be higher than that. So companies that were in trouble before or had risky financials before a crisis obviously get whacked. But yield, and in double Bs, it's actually a lot better. It's 10% or even below that. It will eventually default over a 5-year period.
And most of those will get downgraded before they default, right? So if you are rebalancing in double Bs, you're basically okay.
Yeah, and this is one of the great, misconceptions about, especially, let's talk about triple Bs as well, because there's been a lot of people bearish on triple Bs, and they've actually performed quite well in this downturn relative to lower rated credit. Nothing ever jump to default is what we call it. Things don't jump to default. They go through restructurings before they file. They get downgraded. It's a process. It's something that takes a long time to come to fruition. And so you don't have a bond just go from par to zero. That doesn't really happen. It takes a while. And all that time you're earning your yield or you're earning your coupon. So when yields are high like they are now, you are getting compensated for a lot of that loss. And whereas we would have said, don't even bother going below double B 9 months ago, and did say that. Now you can actually reach a little more down into the single B and maybe even to some triple Cs, and have a lot more protection because you're earning so much on the carry. And so that's the margin of safety, if you will, that you get in high yield with higher yields right now.